Hi there, Phil Sowman here, Core Brokers. Going live today is just taking you through the process of some of the things which we think are important when you're considering embarking on a risk protection program. Now, of course, historically, and it is always advisable that you want to start accumulating or putting in place your risk protection when you're young. And there's a good reason to do that, because you're healthy, you have no pre-existing conditions, and the underwriting is at its most simplest and straightforward. So when you're looking at a suite of insurance products, which could be from health insurance to income protection to trauma to total permanent disability through to life assurance, all those products are far easier to get when you've got basically a clean slate to start with. But of course, here you are, your late 20s, early 30s, family, mortgage, commitments, income, protecting the family. And you put in place a program which is covering a whole raft of scenarios. And of course, at this stage, you've probably gone through this, the 6-step process of looking at your situation, looking at your needs, looking at what are the solutions to those needs. And of course, that is a great place to start. You've looked at your situation, and you understand that insurance is part of the solution to protecting your future well-being of your family, your business, and yourself. So the other thing I like to look at is when you're starting out, there also has to be some sort of, I don't know, for want of a better way of putting it, an exit strategy. Because you set up a program which has very good trauma cover, top of the range income cover, top of the range health cover, and it's all very affordable when you're 30 and healthy. But as you go through life, often the needs for these products doesn't go away, it just changes and evolves. But what doesn't change is that the cost of these products will go up over time. So what I mean is that an exit strategy is a strategy to be able to control the premiums. So having put in place a comprehensive risk protection program, that you need to be able to understand what happens when the premiums become uncontrollable. And we see this with a number of contracts. Health insurance escalates dramatically, certainly post 40, 45. And as you get towards 60 and beyond, it becomes, for many people, just plain unaffordable. But this can also happen with income protection, it can happen with life assurance, it can happen with trauma insurance. So you need to be able to have a little bit of an understanding of the things you can do to control those premiums as your situation changes. And not understanding that at the beginning can sometimes create difficulties, because you've started off with a perfectly good program, it's running very well, and all of a sudden the insurance company hikes the premium by 30%. Ouch. Still need the cover, still need the protection. Many of the issues that were being covered 10 years before still exist in some shape or form. But what's changed in that 10 or 15 years is health. So your options become quite limited in relation to what you can do. So you can't just take it to the market and say, okay, this doesn't fit me anymore, what else can we look at? And I have clients who get to the stage where they have an unaffordable program, but their options are not there to go to the market and get a better product, a better way of doing things, because health doesn't allow it. So you have to look within the insurance company that you select. is what are the options that they have within their basket of products, which would allow you to downgrade the cover to make things more affordable and sustainable. I mean, medical insurance is an obvious one. You can play with excesses as you get older, so you can start with a medical insurance that is really giving you good coverages and good immediate cover. Then you can go to the other extreme. You're now retired, you have money in the bank, and what your medical insurance is going to do is protect that money in the bank if something really, really significant happens. And suddenly you've got a $10,000 or $20,000 or $50,000 prescription cost, which starts to eat into your retirement savings. Income protection. Yes, sure, you start off, you're 30, you want it to pay for as long as possible. But you want to look into the options as you get older of whether you can reduce the term of the payment. And if you do, what are the rules around that? So you need to understand that what you start with is not what you're going to finish with, because we all get older and our circumstances change. So we need to understand that beyond having set it up, what can we do in the future? Life assurance. Okay, so we start off, we've got mortgages, young family, and a whole host of things which need to be paid in the event of our death. Advance it 25, 30 years. We still want a payment, but we don't necessarily want a payment that is triggered by a sudden death event. So we may well be able to downgrade life assurance in its purest form to purely a terminal illness benefit. I mean, terminal illness is a major drain on a family's resources, emotionally and financially. So having a product which gives you the option to downgrade or alter to more suit your needs at a time when, yes, you do need a cover if you're going to die, but you don't need a cover necessarily the day you die suddenly. So you need to be able to get inside your product and know, okay, I've taken the trauma cover. I've got everything covered. It's all great. It's affordable. I'm young, I'm healthy, and it's fine. So now we're 50. And probably we start to look at some of our friends and go, well, Joe got cancer, or Joe had this, or whatever. And maybe the trauma cover is more important. But maybe the financial need for trauma is not so immediate. So looking at your product to be able to move it from being a fully comprehensive trauma coverage to something which is looking at more severe events is always a good thing to be able to understand within the insurer that you're choosing. So what I'm trying to say is that if you're starting with a product, make sure that you get good advice around the sustainability of that product for you as a client who's going to have to pay the premiums. Quite often the easy part is starting it because it's cheap, it's good value for money, and it's going to do its job. The hard thing happens when you've got forward 20, 30 years. And some of the situations which existed when you started it are still there. You still have family commitments. You still have responsibilities, and you need to have them covered. But what you've now got is something which is a major monthly cost. So get professional advice. And of course, linked to this is a ability to make an appointment, and we can have a discussion around this, because you don't want to just look at your risk protection as a one-off event. That, okay, I've done that, I'm 30 years old, It's done and dusted. I put it in the drawer, forget about it. Because eventually the insurance company will send you an annual renewal, which you will go, wow, how did that happen? And quite often this happens over time. So you'll find your $50 premium becomes $51 and then $52. And then over a period of time, all of a sudden, you turn around and this thing's now $150 a month. And it's now just being adjusted to $200. So don't let your premiums get so high that you have to make the decision to, well, I can't afford it, I can't have it. Or I've got to reduce my cover to such a level that I might as well not have it. So make sure that you get advice when you're starting your contract. Then what happens when this thing becomes expensive? Can I make alterations to it? What happens if I make alterations to it? Will it give me the same protection, similar protection? Will it be sufficient when I'm now 50 and I still have commitments? Just those kids are now maybe more expensive than ever because they're off at university or they're doing very well at sport, and you need to be around to help them. So just keep in mind that risk protection is not something that you should just go, yeah, that's fine, start it. You need to evaluate it, and you need to ask, I think, at the beginning, what happens when I'm old and I can't afford these premiums? What solutions have you got for me, advisor, on how to control the premiums? Not just simply, well, reduce the benefits. Well, that's great. You know, you've got $100,000 worth of life cover or $200,000 worth of life cover. Of course, you have the premium, you have the cover, you have the premium. But what happens if you really need to have that extra 100, particularly if things are really bad? You need to have an affordable option, or at least understand there are options to shift to that will control your premiums going forward. So that is my chat for the day, I suppose. I'm sitting here having my coffee as usual, and I am available to have a discussion. You can go to the link online, make an appointment in the diary, and I'm happy to do a telephone chat, although I do prefer to have a video chat because at least you can see what I am up to and I can see you, I suppose. So it makes it easy. You can do it at a time to suit you, at a place to suit you, as long as you've got a device which will take a video. And now, you know, with Zoom being very common, you can do it on a phone, you can do it on an iPad. You don't even need a computer nowadays. So it is easy to get advice. And I like the way my books are falling off the shelf on the back. But it's easy to get advice, and you can just connect with me anytime, and we're happy to go over this with you. We're happy to look at the program you have in existence now and say, okay, yes, of course, you'll be able to do this and this with this product. And so at least you know what some of the options you have with your probably ever-increasing risk protection program. So thank you, have a good day, and I'm here to help. If any of these issues which I've raised are important to you, please feel free to reach out and we can have a discussion. So thank you, have a good day.